Hi, everyone, and welcome to today's webinar, The Rise of Digital Assets, Risks and Opportunities for Advisors. Before we begin, we'd like to take a moment to share a few important notes with the audience. The ratings, financial analysis, projections, and other observations constituting part of the information contained herein are and must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities. We strongly recommend you speak with a qualified financial advisor regarding your own unique circumstances. We ask that no one record this webinar without Moody's explicit written permission and remind you that no one has permission to quote any of the comments made or questions asked by the webinar audience. Today's webinar is also being recorded. All members of the audience are currently on mute. If you have a question, we encourage you to type it into the Q&A box, and we ask that you please keep your questions as generic as possible and avoid any personal or client-specific information. So let's jump into today's session. Today, we welcome Victor Lee, Research Advisor at Farine Capital, and Ryan Clements, Director at the Alberta Securities Commission. We'll be exploring the essential risks and exciting opportunities within digital assets, along with insights on crypto regulation and fintech innovation. Whether you're new to digital currencies or looking to expand your expertise, today's session will offer actionable strategies to effectively guide clients and maintain a competitive advantage in a rapidly changing market. Thank you both so much for taking the time to join us today. So I think we'll start the discussion with yourself, Victor. And I guess we'd love to know, how can we compare digital assets to traditional asset classes, and where do we see the most compelling opportunities for advisors?
Yeah, I think that's a very important question. Whenever there's a new emerging asset class like a digital asset, it's important to understand some unique attributes or a property of that asset class. In this case, when we say digital asset, I refer to the native crypto token because a digital asset can be very broad. I'm just going to narrow down to this definition. Native crypto token typically are the issue on a public blockchain, for example, Bitcoin, Ethereum. The network generally have three unique properties. One is open source and permissionless assets. So that means that you can see the code, you can use the network without anyone's permission. Why this is important is that you can do a parallel innovation without permission from any single authority or intermediary. For example, if you are a developer, you can build an application on top of Ethereum, on top of Bitcoin network without asking for anyone's approval. So that's one first unique property. Second one is decentralized trust and governance. So let's say today you want to change the underlying protocol of a network. You cannot change unilaterally. Nobody, not even say the core developer or the Ethereum Foundation or so on and so forth, the entity that helped launch the network, you require a community consensus. So that's something different than traditional security, which generally have an entity behind those security. The final attribute is unique is censorship resistant. What does that mean? That means that if today I want to send a Bitcoin to Ryan, there's nobody can stop me. Nobody can stop me. I can almost guarantee 100% that I will able to send to Ryan if I know Ryan's address. While you say, well, why this matter? It does matter. Some say that the freedom to transact, the freedom to finance is required for freedom of expression. The most easy way for government to oppress the opposition, dissenting voice, is to take away their finance so that people cannot go to protest, people cannot raise capital to support opposition. So that's also quite important for democracy and the societal benefit in general. Another unique things about digital asset is that the supply of the token are generally predefined in the code. You can look into the code because it's open source. Anyone can look into it. And in many cases, the maximum supply usually is capped. For example, in case of Bitcoin, is 21 million Bitcoin is fixed. If you want to change it, you better convince the entire community, developers, stakeholders, so on and so forth, even user to agree to it. So no a single person or entity can unilaterally change the supply of the token. Then you say, okay, that's all nice, and why does it has value? I think this question valuation is a very hot topic, especially among financial investment professionals. And there's many ways to value and depend on whether the network generates cash flow or not. For example, for Bitcoin, generally we consider is a store value token. Then you could say, okay, what is like of a similar store value asset like gold? What's the market cap of gold? Or we can look at what's the market cap of silver, or even US dollar. So you can use a comparable asset method to say what's the potential, what's the addressable market size. And if the token, the network generate cash flow, then you can use the DCF model, which all the investment professional familiar with this dividend discounted cash flow model. In case of a public network, it doesn't always the cash flow doesn't always distribute in form of token. The more often than not is that the network usually burn it. It's almost like a stock buyback, or they accrue to the treasury, the treasury, the protocol treasury. So the treasury can use it, either burn it or use to support the development of the network. And finally, if there's no cash flow, then McAfee law can be useful as a relative valuation too. So McAfee law says that the value of a communication network is proportionally to the square of the number of connection or the user. So if a network has more user, in relative sense, they should have more value. So then there's many other valuation methods which we will not get into in the detail, but that's roughly the attribute, the value of the digital token. Okay, so I think the question as a financial advisor, you probably have clients have a diversified investment portfolio of traditional asset. The next question to ask is what's the role of a digital asset, crypto asset in the traditional investment portfolio? I would say I will give you these three roles to consider. The first one is definitely the high growth potential. Because it's an emerging asset class, not everyone understood well, and it has a lot of room to grow. For example, for Bitcoin, the last 10 years annualized return is roughly about 70 to 80% per year on average. Ether for the last 10 years is annualized return is about 120 to 30%. So that's true for any emerging network or emerging use case or emerging economy. And in this case, we talk about the on-chain economy. The second benefit I would say you could bring to the traditional asset class is diversification. Because as I mentioned in the previous slide, there's some unique property of factors that affecting the network, the tokens, utility, the characteristic. Therefore, you will imagine that the risk factor drive the digital asset may not be overlapping 100% with the traditional asset class. Therefore, the correlation might be low to moderate. So there's some diversification benefit. But in a recent case, you also notice that in case of a market distress, like last week, you do see a rising correlation between digital asset and traditional asset like stock. And also as the adoption of the holding of this kind of asset more widen among investors, you will expect the correlation will increase. So that's something to consider. And finally is the investment horizon. As any emerging economy or emerging asset class or emerging technology is not for short-term investment. You would expect that it's more like a venture capital. You need a longer time commitment to hold asset to ensure that you have a good return because they tend to be very volatile, which I will talk in the next slide about the volatility. Okay, before we go to the volatility, there's one more slide I want to show you, is that, what as a financial advisor, what could you do? If you do believe this emerging asset class, what could you do? Well, if your client only have traditional asset portfolio, one thing you could consider is have a moderate allocation to the high quality digital asset like Bitcoin, Ether. Moderate, I mean, 5% or less. If you're a little bit more higher risk tolerance, maybe go up to 10%. But in general speaking, a small allocation would be very prudent. And within the digital asset, there are some promising, new trend or segment that you could investigate further. The first one is decentralized finance. Sometimes we call them DeFi, decentralized finance, which is the opposite of the traditional finance, which is centralized finance. And in this area, in DeFi, yield generating is a hot topic. As you know that most of digital asset doesn't provide any income dividends. So how could you generate income if your investor need yield? You could do lending. There's a decentralized lending protocol like Aave, which you can lend them out and generate yield. Or you can do staking. You can stake your ETH and get paid for providing the service, which is a security service to the network. Another trend is that you have probably seen in the last couple of years is tokenization of traditional asset. We call them real world asset. It can be stock, it can be gold, it can be real estate. So basically what the traditional Wall Street doing is that they bring the traditional asset on their balance sheet to tokenize on blockchain so that they can much more efficient, transparent transaction and management. Right now, you probably heard one of the biggest money market fund was tokenized by BlackRock. And most of those tokenization, they tokenize on multiple blockchain, but the majority are on Ethereum. And finally, another area you could investigate further is the intersection between artificial intelligence and blockchain. The development of artificial intelligence actually have a lot to learn from blockchain's development. For example, privacy. For example, decentralized network, so that no single entity can have all the power of the AI, which could be very important for democracy and also for the survival of humanity. As Geoffrey Hinton often talk about, there's no guarantee that AI will always act in the best interest of humanity. So that's some of the three promising area that you can look into if you are interested in this segment. Next slide, please.
Great. Thank you so much, Victor. And what actionable guidance can advisors follow to integrate digital assets responsibly while maintaining compliance and client trust?
Okay, so next slide. I'll show you. So, like any investment advisor, I would definitely recommend do due diligence on the token, the network behind the token. So before you invest in any digital token, you should do due diligence. Just like we investment professional, we will do due diligence on the company, before we buy the stock or buy the bond. Same thing applied here. At the bottom of this slide, I list some of the most important due diligence as the checklist that I use personally when I do investment research for my hedge fund. The second thing is that you make sure, given that the digital asset is very, very volatile and is an emerging technology, emerging asset class, the investor, your client, should have high risk tolerance. The risk tolerance is divided into two parts. Now, one is that there's a chance that some blockchain network become obsolete. Just like a company can go out of business, so is a blockchain network. They may not die 100%, but they may become irrelevant because there's a better technology, better blockchain emerge. So that's one thing. The second one is the volatility. The price volatility is extraordinarily high. I give you a comparison. So S&P 500 implied annualized volatility is about 17%. Bitcoin's implied volatility right now is about 40 to 50%, where Ether's volatility is around 60 to 70%. As you can see, it's really several times higher than the stock index. But that said, because the wider adoption, the volatility of Bitcoin, Ether has been declining over the longer time frame, over, let's say, last 5 years, 10 years or so. In case of Bitcoin, right now, the 40 to 50% volatility is roughly slightly higher than some individual tech stock like NVIDIA. So NVIDIA's stock is roughly 40% annualized volatility. So Bitcoin is slightly higher. And also the third one to consider is make sure that your client are willing to commit capital for longer term holding. And if you look at Bitcoin and Ether cycle, from peak to peak is roughly 4 years. So imagine if you bought today at a peak of the cycle, that means that you should see a possible return if you're holding 4 years or longer. So that's the three suggestions that I can have for you. And in terms of due diligence, it depends on your knowledge, capability, and time frame. For a hedge fund like ours, we have to do very thorough due diligence, particularly related to the token economic design of the network, which is one of the unique features that compared to traditional company, because the network is open source, is permissionless. So the token design is very important to ensure all the parties willing to contribute to the benefit of the network, the growth of the network, the security of the network. Okay, next slide, please. Okay, so go ahead.
No, I was just going to ask you the question, but
yeah,
it's okay. When an investor owns a digital asset, what do they actually own, and how can advisors explain this concept clearly to clients?
Yeah, this is a very interesting question, because by nature, digital asset or crypto asset is intangible, right? There's nothing you can hold on to it. So what is that when you own a digital asset or crypto asset? Well, you can actually have a digital wallet that own the key to the token. The token actually is not in your digital wallet. The wallet can be software wallet or hardware wallet, but the key allow you to access to that token, to the address on the network. If you buy a token directly from exchange, whether it's a centralized exchange like Coinbase or decentralized exchange like a Uniswap, you can actually withdraw the token to your own personal crypto wallet. In case of US, the regulator actually allow in-kind redemption. For example, Bitwise Bitcoin ETF allow you withdraw Bitcoin to your own personal wallet. You have to take care of it. You don't have to only withdraw in cash. The second benefit of the right of owning a digital asset is that you can use the network. You can use the network. For example, if you want to do any financial or activity on Ethereum or Bitcoin, you have to pay the gas fee, the transaction fee. Well, the transaction is paid in the native token. In case of Ethereum network, is the ETH. In case of Bitcoin, you have to pay Bitcoin as in transaction fees. And some network, the owning a token allow you to vote. As I mentioned earlier, is a public network, public blockchain network, or decentralized governance. So there's no single entity, a person can change unless there's consensus. So some network use a token to vote, so that if you have owned a token, you can have the right to vote on the major decision of the network. And then staking. So there's many network allow you lock up your token either for security or for other purpose that you will get paid in form of a small amount of token in return, almost like a compensation for your service. For example, if you own ETH, you can stake ETH as a validator so that you can provide security to the Ethereum network and you get paid in ETH as well. Right now, the yield is roughly just below 3%. And finally, as I mentioned earlier, some network may distribute cash flow or buy back token if the network generate incomes, generate revenues. So that's some of the right you have as a token holder. So I pass back to.
Thank you so much, Victor. Yes, we can pass it to Ryan. Ryan, what are the main responsibilities of federal and provincial regulators in Canada's crypto asset sector?
Sure, happy to answer that question. In the process of answering that question, I want to just set a bit of an outline for what I feel could be useful. I suspect on the call that there's a variety of expertise. There's likely advisors and other professionals who are already in the crypto asset ecosystem, and then there's others who are not familiar with it. So my goal is to kind of walk through three main objectives. Number one, how do investors participate in this sector? Number two, what are some of the key regulatory and compliance updates, including both federal and provincials? I am the director of advanced research at the Alberta Securities Commission, and I'm also the chair of the Financial Innovation Hub at the Canadian Securities Administrators. And then finally, I just want to provide a little bit of a risk awareness around this subject. Really appreciate the topics that Victor was presenting. What we see when I say we, I mean the securities regulators, and we intersect with other financial market agencies through the heads of agencies. We intersect with the Department of Finance, Bank of Canada, OSFI, international regulators quite extensively. we actually don't see a lot of retail investor participation in what we would define as self-custody. So for those of you who are familiar a little bit with kind of at least the backstory or the ethos of crypto, it was formed shortly after the financial crisis, and the Satoshi white paper was launched. After the Satoshi white paper, which led to Bitcoin, there was subsequent things that Ethereum was created, a variety of other programmable blockchains. But the ethos, the fundamental ethos of this sector was supposed to be disintermediation. Decentralization. So there was concerns early on, and I've been in this space for a very long time. There was a lot of concerns coming out of the global financial crisis that the intermediation itself, excessive risk taking by banks, led to pathologies in the financial market that almost took out the system. So the idea behind crypto was, let's disintermediate the banks, let's disintermediate the funds, let's disintermediate the investment dealers and create this peer-to-peer ecosystem for finance where we can share digital, we can transfer digital stores of value, and then with the creation of Ethereum and subsequent programmable blockchains, we could build these decentralized apps. And that exists. That theory is real. However, what we've seen at the regulator is most retail investors don't do that. They don't do that, and by most I mean a significant proportion of investors do not do self-custody. They do not do direct peer-to-peer. What they actually do is they use an intermediary. The intermediary is providing services like custody so that the investor doesn't have to take storage of their private keys. They don't have to worry about cybersecurity controls, but they do rely on an intermediary to provide proper operational controls, proper operational systems governance, ensure solvency, etc. And there's participation through investment funds as well. And that's a really, really important point that I'll just start with, because pretty much the entire regulatory architecture in this space is built on on parameters that apply to intermediaries in the space. There's very, very little regulation that actually exists in self-custody wallets. If you look across, and this isn't just securities, if you look across the financial market ecosystem, from the guidance that FinTrack has provided to money service businesses applying digital, who are virtual currency dealers, to the architecture around securities, guidelines from OSFI, forthcoming Stablecoin Act from the federal government, all of it is in relation to intermediaries. It's not in relation to this self-custody space, which was the original ethos of crypto when it began. Just wanted to make that very clear, because now I'm going to walk into some of these regulatory parameters that have been set, and they've been set because these intermediaries create potential risks that are familiar from intermediation in the traditional financial market. And we've had examples of failures. We've had Quadriga, a platform failure in Canada. We've had FTX, which others are aware of. When intermediaries provide custody, when they facilitate margin lending, provide other financial products, you have familiar investor protection concerns and stability concerns that you have with traditional finance. We've definitely seen that in crypto, which is why the regulatory parameters have been built the way that they are. Can we go to the next slide? So just high level, the oversight of crypto assets is a shared responsibility between a variety of federal and provincial agencies. The anti-money laundering and anti-terrorist financing requirements, supervision of federally regulated financial institutions, retail payment service providers, and soon to be, if the legislation gets passed, stablecoin issuers, non-federally regulated financial institutions, stablecoin issuers, is the responsibility of the federal government. The provincial government has oversight of financial institutions incorporated or formed under a provincial act, conduct and oversight of non-bank businesses. And in relation to securities, the securities are overseen by provincial regulators. The CSA, the Canadian Securities Administrators, is an umbrella body that works to both harmonize policy, but also to facilitate efficient participation by marketplace participants. The CSA doesn't have legal power. The legal power is actually within the provinces themselves. But members of the provincial securities commissions participate in various CSA steering committees and policy working groups to facilitate harmonized policy efficiencies in the market, learning in the market. And as I mentioned, I'm the chair of the CSA Financial Innovation Hub. Interestingly, the point of tokenization got brought up by Victor. We actually just launched last week a tokenization project within the CSA Financial Innovation Hub. So, and you can look me up in LinkedIn. You'll be able to find some details on that. Next slide, please. Okay, so let's get into. Oh, go ahead.
No, it's okay. What are the latest updates from Canadian regulators or any insights into global frameworks influencing domestic policy to sort of complement what you're talking about?
Yeah, absolutely. So next slide, please. Okay. We have been early in this, we meaning the securities regulators have been early in this space in terms of the guidance that we provided to marketplace participants. In 2017 and 2018, we put out successive staff notices, 46307 and 46308, that set out the application of securities rules to initial coin offerings. And so the context at the time, this was the kind of the first crypto bubble prior to 2020, but there was a lot of token distribution. So on these programmable blockchains, primarily Ethereum, there were a variety of apps being built, and a lot of the apps had governance tokens associated with them or other types of tokens, some of which had profit participation rates on them. And these two notices, what we said is that when you apply some of the open-ended prongs of the definition of security within the Provincial Securities Act, or apply the definitional rules for derivatives, they actually caught some of these token distribution offerings. And so we set out guidance in that, basically for entrepreneurs and builders in the space to help them not accidentally trip an illegal distribution of a security. That was early guidance, 2017, 2018. Let's go to the next slide, please. Over the last really 6 years, there has been a significant development in securities regulation around custodial crypto asset trading platforms. So if you recall, and you don't need to go back to this slide, but the very first slide where I said there's 3 types of investor participation. You can self-custody, and frankly, when I got involved in this space more than 10 years ago, I was self-custodying crypto assets. But as I mentioned, not a lot of retail investors are doing that. You can use an intermediated platform, or you can use a crypto asset fund, and there's a variety of those in Canada. What we see is most retail investors are using either intermediated entities like crypto asset trading platforms. There's a whole bunch of them out there. I'm not going to name any particular one, but there's a whole bunch that are operating with compliance around rules that we built. And these rules really got catalyzed after the Quadriga failure. Now, some of you may or may not be familiar with Quadriga, but this was the platform. There's been a Netflix documentary built on it, where one individual had control of all the private keys in an omnibus wallet to every single user on the platform, and this individual died. After that happened, this was a Canadian-based platform. After that happened, there was a lot of kind of finger pointing at the regulators, like who's in charge of this thing? Like where are the parameters for operational controls and governance controls and custodial controls and SOC reports and everything else? Who's in charge of that? That led to a consultation paper that happened in 2018, 21402, and then a subsequent staff notice where securities regulators took the position that said securities laws will apply to crypto asset trading platforms depending on the context. Platforms won't be subject to securities laws if, number one, the assets that they trade on their platform aren't securities or derivatives, so the inherent characteristics of those, and number two, the contract ensures immediate delivery of the asset to the user. Now this was provided in 2019, which was 2 years after the guidance that we put out that said some of these crypto assets are actually securities. And so basically what 21327 did is it created basically 2 lanes. Either you're in securities regulation or you're outside of securities regulation. And what is outside of securities regulation was only platforms that trade non-securities. So Bitcoin is not considered a security. Ethereum was not considered a security. There was several of them, and they had to facilitate immediate delivery. If they didn't facilitate immediate delivery to the user, they were providing some type of custodial service, they were caught by securities regulation. And an entire regime has been built around that over the last 6 years. Next slide, please. So when do these requirements apply? Well, the notice in 21327, it says it is always contextually specific. There's no bright line test, but the key issue here is immediate delivery. So the platform must transfer ownership, possession, and control to the user after the transaction. So for example, if I go onto a crypto asset trading platform, a lot of people call them exchanges, but technically they're not exchanges, the way that securities regulators define the word exchange. If you go onto one of those platforms and you put money into the platform and you buy a crypto asset and that crypto asset stays on the platform, meaning you log into this user interface and you can say, oh, I've got, point X of Bitcoin. If you're not controlling the private keys, if that Bitcoin hasn't been sent to you, ownership, possession, and control to a wallet under your exclusive control, then all that you really have is a crypto contract. That's what we call it. If you have the right to subsequent delivery of that crypto asset, and that crypto asset is being held on a platform, you don't actually own the crypto asset. You own a contract. And we define that as an investment contract. Therefore, the platform that is issuing that investment contract to you is subject to securities regulation. Next slide. We put out guidance shortly after 21327 around, okay, well, what are the rules then? What would we apply? What ended up happening is that we started looking at every single platform, put out the guidance in 21329 that says some of these platforms are going to be dealer markets, meaning it's one-to-many type of market. They're providing custody, onboarding, so they're going to have the similar to investment dealer rules within National Instrument 31103 and a variety of other rules as well. Some of the crypto asset trading platforms are facilitating a marketplace function. It's not an exchange. They haven't been recognized as an exchange, but it looks more like an alternative trading system. And so some of the marketplace rules are going to apply. Now, not everything would apply, so we started applying our exemptive relief cases. And at first, we were registering platforms as restricted dealers with time limitation, but now over time, we've moved them into requiring full investment dealer status with the Canadian Investment Regulatory Organization, or CIRO. Next slide, please. After FTX, well, before FTX actually, we also facilitated what we call a pre-registration undertaking regime. So it takes a while to become registered as a CIRO dealer and to gain their status with the securities regulators. So we created a regime that while crypto asset trading platforms were kind of in the queue working on getting their registration, they could still operate under compliance provided they undertake to effectively the same terms and conditions as the registered platforms. We enhanced that investor protection regime after the FTX failure in 2020 to make some prohibitions on margin lending, prohibitions on proprietary tokens, requirements for key personnel, enhanced custodial rules. We also, over time, have moved the registration of these platforms to CIRO, away from the restricted dealer framework. And really, the idea behind this was to ensure that investor protection was facilitated during this period of pre-registration, but also allowing these platforms to operate in good faith under compliance, which is a regime that has been received some positive endorsement internationally. Next slide, please.
And what do you think advisors and their clients need to know about managing volatility, custody, cybersecurity, valuation, and product due diligence?
Yeah, great question. Next slide. So before I get into some of the technical specific things, I will also mention that crypto asset regulation is facilitated cooperatively across the federal agencies, the provincial agencies, and also we work with international groups. That there is a group called the Heads of Agents Regulatory Agency Digital Asset Group. It's chaired by the Department of Finance and Bank of Canada. It includes securities regulators. It includes banking regulators. It includes pretty much all the financial market regulators in Canada. And we work to identify gaps, and we assess policy tools and try to ensure interoperability and not fragmentation. Right now, there's a big focus on stablecoins, given the recent legislative tabling of the Stablecoin Act in Canada. Next slide, please. We also, I mentioned another form of participation is investment funds. And I'm going to tie this into kind of the question and then a final slide on this point. So go back to the very first. You can self-custody. That's available. It's always available. It always has been, but not a lot of retail investors do it. You have intermediated custody, where retail investors are basically using a crypto asset trading platform akin to a stock securities brokerage, allowing the platform to custody and just interfacing in through their tech stack order book. And then the third way is crypto investment funds. Since 2019, we've had crypto investment funds in Canada. There's a lot of financial planning reasons why you would want to use these potentially. They are RSP eligible, where some of them, where holdings in an intermediate crypto asset trading platform aren't RSP eligible. We have provided guidance to investment fund managers and portfolio managers with respect to our expectations for funds investing in crypto assets, including clarifying expectations on custody, liquidity, valuation, yield generating opportunities. Victor had mentioned staking and yield generation in a self-managed way. Well, bucket 2 and bucket 3, the intermediated crypto asset trading platforms and the investment funds facilitates staking as a service effectively through the intermediated crypto asset trading platforms. And some of the investment funds facilitate staking to enhance yield. And so we provided guidance to both of those ends. We have draft amendments to one of our key instruments to introduce specific 81102 to introduce specific provisions, things like investor limits, permissions, custody. Investment funds are publicly traded, and so the issuer of the investment fund is subject to our prospectus rules. There's specific prospectus rules around investment funds and continuous disclosure. So the whole variety of continuous disclosures that come out through for any type of investment fund. The intermediated crypto asset trading platforms are subject to more bespoke disclosures that come through the terms and conditions of registration. Next slide, please. I mentioned stablecoins. We had provided guidance in 2022 that stablecoins may be securities and or derivatives, and that a particular type of fiat-backed would be considered a security or derivatives by the provincial securities regulators. There was an interim framework for the trading of fiat-backed crypto assets, what we call them, or fiat-backed stablecoins, that was issued in fall of 2023. And as some of you may know, there's legislation was tabled recently, the Stablecoin Act, to regulate the issuance of fiat-backed stablecoins by non-prudentially regulated issuers, with subsequent amendments or forthcoming amendments to the Retail Payment Activities Act. And so right now the CSA is collaborating with the federal government on ensuring, the various rules and guidance are in sync and creating kind of clear standards for the marketplace. Final slide. This is probably what the final slide is. Probably what the advisors are most interested in, or those who are you or investors are fairly new to the space. So the first thing I would ask, so look to that gray box. When you're thinking about investor protection, risk, volatility, how does this fit in a portfolio? Should I invest, et cetera, et cetera? One of the first things that you should ask is, what are you actually buying? Are you purchasing the proprietary rights to the crypto asset, meaning you hold that property, or are you buying something else? Because the way that the securities regulators have interpreted and applied the rule framework is that if you're not self-custodying the crypto assets, you're actually purchasing a crypto contract from a intermediated platform. Or in the case of investment fund, you're buying an interest in an investment fund that holds a crypto asset. You're not buying the proprietary rights to the crypto assets. Sometimes colloquially, you'll hear things like, not your keys, not your coins. So if you're not taking management and control and storage and safekeeping of the keys, the private keys associated with crypto asset, then what you're buying is either an investment contract from an intermediary, or you're buying an investment fund, similar to any index fund that you would buy, but just with a different basket of underlying assets. So if you're in, so then you start having to think about these other considerations. So for example, if you're buying a crypto contract on an intermediate platform, you have to think about typical market structure risks like liquidity and trading gates and reliance on marketplace. And the fact that when you participate in that way, you are, despite the ethos of crypto being decentralization, you're very much participating in a centralized ecosystem. You have to think about governance and transparency. You have to think about internal controls and risk management. We have been thinking about this for many years, which is why we've put the conditions on the platforms the way that we have, because we've seen what's happened when there wasn't conditions. We've seen failures around poor operational controls, poor risk management, undisclosed conflicts, promotional activity, things like that. I would strongly encourage you to check which the crypto asset trading platform that you're using to make sure that they are properly regulated and properly in compliance. And we publish all this. You can Google CSA crypto asset trading platforms. You'll see exactly who has the green light and who is in the pre-registration undertaking regime. I would strongly encourage you to use those, because those platforms are subject to the types of internal controls that we have created to prevent scenarios like FTX from happening again. You know, things like fraud and manipulation risk. We have seen this on platforms. You know, a big area for our investment teams right now is maybe a fourth bucket. I mentioned self-custody, intermediate custody, investment funds. We see this other group where sometimes people will organize investment opportunities where you're sending money not to a platform, but to someone or a consortium who's going to invest on your behalf. Be very, very careful of that type of stuff. We've seen a lot of fraud in that space. The typical rug pulls and other types of things that happen when people are sending money to someone else in a collective investment arrangement. Be very careful, because those are actually those type of collective investment arrangements are very much subject to securities rules. Operational and systemic risk. When we get into the systemic risk side, we haven't seen really much by way of systemic risk in the crypto asset sector. Even the crashes that we have seen have been relatively ring fenced within the crypto sector. So like if you look at 2022, it's not like that was akin to 2008. It didn't take down the banks. You know, there are a lot of emerging systemic risk articles in relation to as the two worlds merge. So instead of having parallel systems, you're having things like fiat-backed stablecoins that are causing the two systems to merge. And what that will actually mean, you can see if you look at some of the prudential and other prophylactic type requirements in the tabled Federal Stablecoin Act, you can see some of the systemic safeguards that are designed, like, for example, ensuring one-to-one reserves, having, you know, controls on the composition of those reserves, things like that, not allowing the stablecoin issuers to be depositaries, etc. So that's an area of emerging literature that is very much live right now. And I think that that's it for me. So I think we're having the last 10 minutes for some Q&A.
Thanks so much, Ryan. That was really very informative. Yeah, we would love to just jump into the Q&A. We have a couple of questions here that I'll just throw out, and you can both sort of just catch them as you see them land, see where they go. How do you see digital assets fitting into a traditional wealth management strategy over the next few years?
Probably Victor's better to answer that one, because I'm a regulator.
I think one of my slides actually answered this question, right? What's the role of digital asset in the traditional asset portfolio? From potential higher return, diversification, and also longer term investment horizon. That probably I would say that's something that the role, what the strategy would be. Maybe the user is asking different kind of question beyond that what I answer in the slide, but that's what I would say.
Okay. And how do you expect institutional adoption of digital assets to shape client expectations?
Institutional adoption is definitely give this digital asset or crypto asset more legitimacy. When you saw big Wall Street company like BlackRock was launched Bitcoin ETF, Ether ETF, they tokenize on Ethereum blockchain and some other smaller blockchain, you did definitely feel there's sense of legitimacy to this new emerging asset class.
Yeah, if I can just add on that, like
Mhm.
I mentioned within the CSA Financial Innovation Hub, we've launched a project tokenization where we're seeking out expressions of interest and expressions of participation on how tokenization can positively, evolve and shape financial markets, and what are the use cases are, what are the risks that we should be aware of, how is how is the technology integrated in terms of architecture. And one of the things that I think where the institutions have been leading the conversation is they've been moving the conversation away from just speculative buying of various tokens to blockchain as infrastructure, blockchain as enhanced clearing and settlement, integration like of the technology into traditional financial market architecture to facilitate better processes, whether that's in global remittance through a stable coin, or whether that's through securities trading and settlement using blockchain instead of the way that it's been done. I think it's really the institutions that have been kind of leading that movement away from just because the zeitgeist got caught up very much, I think, with the bubbles, particularly during COVID in 2022, of just kind of like speculative trading of crypto assets. And it's like, what are those crypto? I don't know, but I want to buy one. It's going up, right? Like that's kind of the conversations that were happening so much. And then throw in NFTs in there, Bored Apes, and there was just kind of this speculative frenzy, really, that happened. And the institutions, I think, have been leading the signal on, okay, let's pause, like that's there, but let's think about next generation evolving architecture, and this technology can be really useful in terms of that. And so as securities regulators within the Financial Innovation Hub, we're seeking guidance and input and education on that to understand, hey, do we need to like adjust any of our rules maybe in order to facilitate the integration points of these technologies?
Right, that makes a lot of sense. And I guess we could, as a final question that I think makes the most sense here is, when dealing with clients, what are the types of client questions or misconceptions that you both feel advisors should be prepared to address when discussing digital assets? Like, are there very common, of course, there's always the common questions or misconceptions around digital assets. What would you say advisors can prepare for?
Well, maybe I'll go first. Speaking as a regulator, advisors are subject to know your client and know your product and suitability rules, and just stay within the parameters of the rules. Like that's really, really important, actually. So, some of the exposure to this sector very well will be suitable for certain types of investors. Other investors, it won't be suitable. So, like, our rules have been designed to be technologically agnostic, and so that it does require the advisor to know their client and understand what a suitable recommendation is. And so that's kind of the advice I would say, is to stay within the lanes of the advice, the guidance that you have. Like one area that we're thinking about a lot in the securities regulation is the DIY space. The do it yourself through what we call order execution only platforms, so trading apps, etc. What level of protection guidance does that need to have? And CIRO just put out a paper just recently on, potentially adjusting some of their guidance and their when it comes to recommendations for DIY investors. So that's a bit of a different issue. It's not direct to your question. Your question is more in relation to the advisors. I guess the only thing else I'll add is if it is suitable, then understand the means of participation and what is the best way of participating. And there's lots of, I want to make it clear that there's a lot of value to using intermediated platforms. There's liquidity, there's custody. It's not easy to get liquidity or ensure self-custody. So intermediated platforms have a really important role in the ecosystem. Just make sure you're using one that's compliant with the securities regulation, and we publish that.
Ryan talked a lot about very important consideration for your client. I would say perhaps go back to more fundamental, why. The question is why. You already have so many investment product available particularly in traditional finance. As what's the value proposition of this new emerging asset class? I think it's very important to articulate that value proposition, because time will come that the market drop 20, 30, 40, 50, even 90%. Then you will facing a lot of questions from clients. So why do you recommend this product? Look, the price dropped, so much. There will be always a time that lack of understanding, lack of a conviction will force your client to sell at the wrong time, right? They're underprepared the volatility in this new asset class.
Right, that makes sense.
That's a good point.
Yes, did you want to add anything else, Ryan, before we?
No, I just agree with that. I think behavioral economics and talking clients off the ledge sometimes, and selling at the bottom and buying at the top, those are things that good advisors are really good at.
Makes sense. Well, thank you both so much for joining us today and taking the time to share your knowledge and expertise. We had really great attendance today and some really, really great questions from the audience. We'd love to have you back for a future session, and we will keep the audience posted on when that will be. We'd like to also thank everyone who attended for taking the time today. And just a reminder that we will have a replay of this event. It'll be available in the next couple of days. Oh, we're getting lots of fun reactions and hand clapping, so that's exciting. We will have a replay of this event available, so that will be going out in a couple of days. You'll receive that by email. If you have any questions about our events, please feel free to reach out to us at support.csi.ca. And thank you again, everyone, for attending. Have a lovely day.
Thank you for having me.
Yes, absolutely.
Thank you.
Bye.
Thank you.